The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alistair McLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alistair McLeod of Gold Money, and with me on the line from the other side of the pond, I have Erik Townsend, who is a private investor who made his money in the 1990s tech boom, and is very much involved with, in the past, with Chris Martenson and currently with financialsense.com, and has his own website, which is eriktownsend.com. Welcome to this podcast, Erik.
Thanks very much, Alistair. It's a pleasure to be here.
Now, I had earlier this week, I had an interesting interview with Mark Skousen, and he, as a libertarian, was actually sort of quite optimistic. I think we were talking mainly about the US economy. He was pointing to the enormous strides being made in technology in particular, which would be something that you're very familiar with. What's your view on the US economy? Is it right to be optimistic, or is he just looking at the good parts, if you like, and ignoring the rest?
Well, I think it is right to be optimistic, but I see it for a completely different reason, which is that all of the fears people have about the United States, the people who think that the U.S. dollar is going to crash and the world's coming to an end and so forth, those fears are based on some pretty good, well-founded concerns, but those things are going to happen to Europe and Japan first before they happen to the United States. And the United States is going to continue to be the benefactor of flight capital from Europe and Japan, as is already happening. And I think that's going to push the dollar much higher. And it's also, unfortunately, in the long run, in my opinion, going to create the cover that the Fed needs, if you will, in order to print even more dollars. Because if the dollar is appreciating, it gives them more room to print more of them.
Well, we've had that's I think really quite topical, because we had Ben Bernanke's testimony to Congress yesterday and the FOMC minutes, and huge volatility in all markets. And ahead of that, the signals being sent out seem to be fishing for what would happen if we started withdrawing QE. Bernanke said, no, we're not going to withdraw QE until things get better. In other words, we're not going to withdraw it in the foreseeable future. Everybody all the big central banks, it seems to me, are really printing money. So you're saying that, I suppose that the main merit of the US dollar in this race is that it is, if you like, the currency which everybody retreats into. That's presumably why you would see it being stronger than the others.
That's exactly right, and that's the only reason. And unfortunately, that is going to pave the way for the U.S. government to continue to be even more reckless than it's already been. And the ultimate consequences of this will be absolutely horrific for the United States. I think that a sovereign bond and currency crisis is entirely realistic and possible for the U.S., but a lot of people think it's about to happen imminently any time now, and I think it's actually about to happen imminently in Japan, and that's just going to result in more flight capital coming into the United States.
Yes, but apart from that flight capital, if Japan really does get into big difficulties, and it seems to me they're already there. I mean, we've had a very sharp fall in the currency, and they're expanding the rate of yen in circulation, basically to just finance themselves, apart from anything else, because the savings rate has gone way down. They've now got a trade deficit. I mean, Japan is in a horrid mess. But how long can, if you like, an economy like Japan undermine its currency without people thinking that this is a problem for all currencies, including the dollar? In other words, how far behind do you think the dollar is in this process?
Boy, that's a really tough one to call. It seems to me incomprehensible that it's gone this long without something really falling apart. But on the other hand, if you look at Japan was diagnosed as basically a walking dead zombie economy, 20 years ago? And it somehow managed to struggle along in a deflationary condition with very difficult economic conditions and very low interest rates for 20 years now. I don't think it's going to last that long, because I think this is all kind of coming to a head. But I do think we have several years of the U.S. dollar being the cleanest dirty shirt in the pile, so to speak. And it's, I'm afraid, going to create a false sense of security. The Paul Krugmans of the world are going to say, look, see, there's really no adverse consequence to printing all this money. We should do more of it. And I'm afraid that that's what's likely to happen.
Yeah, I think I can agree with that. But where does this go? I mean, presumably at the end of the day, there's got to be, I mean, the dollar, if you like, on your analysis, is only temporarily going to continue as the dollar. And at some stage, it's going to end up disappearing up its own backside, if you like. So we then have to have a new currency. How do you see that end game playing out?
I think it all has to go to a global currency, because really the options for Western governments are either to say, okay, boy, we screwed up by recklessly printing too much money and created a crisis which undermined our own economies, and therefore, we're all going to be poor for the next 30 or 40 years. Or using the power and influence that these governments have to change the world. And what I see is somehow a global currency replacing the U.S. dollar as the global reserve currency, and everyone being forced in order to do international trade to using that new currency, a bunch of more power for the new central bankers, which of course would be now international central bankers, presumably representative of various different national governments, but still kind of independently. So I think that it has to go somehow towards a new reserve currency, and I would expect that making this new global currency the world's new reserve currency would be the mechanism through which they force the conversion out of everybody who has dollars at what probably would be an unattractive conversion rate for them, but creating new units of this global currency at more attractive rates for the well-connected. How they manage to pull the U.S. out of what would otherwise be an inflationary Great Depression through this, I'm not sure that they can. I'm not saying that they're going to solve everything, but I think that the last-ditch effort will be centered around a move to a global currency.
Well, it's still going to be, I think, on that analysis, particularly on that analysis, a question of crisis first, solution second, because to do this deliberately means that the United States would have to give up an enormous advantage in having the US dollar as the international currency.
And I don't think that the U.S. is going to do that until it has absolutely no other choice. And therefore, I think that what the U.S. is likely to do is to take advantage of the flight capital coming in, which is strengthening the dollar, and it's masking some of the adverse effects of quantitative easing. I think that will be the excuse for even more quantitative easing. So this big Fed blows up the world that's going on in the last couple of days is all because basically Ben Bernanke said nothing new, said they could either dial the stimulus up or down as economic conditions warranted. And then one small line in the Fed minutes released later in the day said, we're thinking about the possibility of maybe considering to taper in a small way as early as June. And that's panicked global markets. So imagine what it comes down to when they can't stimulate anymore, when they have to withdraw this stimulus. And the mechanism for that is U.S. interest rates. When they get to the point where U.S. interest rates are spiking much higher, increasing the cost of government borrowing, that's when they're unable to stop printing more money. And at that point, anything could happen.
Yeah, I think that's right. The replacement currency, would you see this as being a paper currency? Or because, another paper currency presumably suffers from the same vices, except instead of just the US printing and the Bank of England printing and the ECB pretending it's not printing but printing like fury and the BOJ printing like fury, we're going to have the four of them getting together in effect, and anyone else, if you like, perhaps through the BIS, I don't know, getting together and deciding how much they're going to print this month. It's not going to be any different in that sense, is it?
No, I think it's almost absolutely assured to be a fiat currency. And, it's something that I've always had a different view on than some other commentators. People will say, well, we just have to go back to a hard currency, back to a gold standard. Now, you'll have no trouble persuading me that that's a good idea, that we ought to do that. But what you're talking about doing by going back to a gold standard is taking the power away from the most powerful people in the world, those who are the central bankers who have the ability to print money out of thin air, by going to a gold standard, you would be taking that power away from them so that governments no longer have the ability to debase a nation's currency at the expense of its savers to benefit the elite political class. Why would they give up that power? If there were some kind of revolution that took it away from them, that's plausible, but we don't have those kinds of conditions. Certainly in the United States, most people are cheering the government's actions. They think that the stimulus that they perceive as being intended to help the economy is a wonderful thing. Tax the rich, print more money, rah, 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 re-elect Obama for a third term if that were allowed. And hey, we don't follow the Constitution anymore, so maybe we will.
Yes, I think I agree with that. Very few people seem to really appreciate how much power printing of money involves, and or gives the central bank or gives the government, and they're not going to give it up at all, I think, if they can possibly avoid it. So I can see that. But having said that, there's an interesting situation in Asia, because the Russians and the Chinese in particular have been adding to their gold holdings. In the case of China, they haven't really shown this in the central bank yet, but they do seem to be moving towards a future, if you like, international trade settlement arrangement, which involves, if not gold as such, the implication that there is gold there to back it. Now, meanwhile, what we've done in the West is we've actually got rid of all our gold, it would seem. The Far East has got it. How do we resolve that difference? Because this, international trade does now involve Asia, I think, more than anything else. I mean, even putting Japan out of that description.
Oh, it absolutely involves Asia, and I think what we're seeing are the very early stages of the 500-year East-West power cycle reversing to where Asia is going to be the next hegemonic world superpower. And, Jim Paplata and I did a podcast about this, talking about the formative Cold War between China and the United States. And really, we're seeing the very early stages of China positioning itself to weather the storm of a U.S. economic collapse. So I think that it's not just gold. Certainly, Asians are accumulating as much gold as they can. The purpose of that, in my opinion, is a hedge to protect them if their U.S. dollar holdings should collapse in value, or if the U.S. should selectively default, which could happen in an escalating Cold War. The U.S. declares China to be the bad guys and says we're not going to pay our debts back to China. They need to have some kind of wealth that insulates them if their U.S. dollar holdings, which are just ginormous in size, were ever dishonored somehow. So that's why the gold. But look at what else they're doing. They're stockpiling copper. They're stockpiling other commodities. They're stockpiling coal. Everything that China is dependent on the Western world for, they're buying it up in bulk and stockpiling it. Now, that, to a person who understands just-in-time inventory, that either says that they're economically incompetent, or they see something coming and they see the need to be prepared for an environment where China might have to survive several years without being able to do commerce with the West. And if you think of it in those terms, everything they've done in the last 5 years is, frankly, pretty astute in preparing China as a nation for that kind of outcome.
Yes. And Erik, do you see them reducing their dollar holdings to do this, or are they rather marking time on their dollar holdings and just sort of putting new money into extra copper, coal, silver, gold, oil, whatever?
Well, China has reduced the rate at which it was accumulating and growing its dollar holdings. The way I think China is looking at its dollar holdings is, okay, if we, China, were to try to just sell all of our U.S. dollars, first of all, it would lead to some kind of war with the United States. Second of all, we'd crash the market and we wouldn't get much value out of them. I think China sees the fact that it is the largest holder of U.S. treasuries, other than the Fed, as a power chip. They're probably thinking, okay, we got to do something to protect ourselves, so if we don't get paid back this money, we'll be able to survive. But since we've got this huge amount of debt, how do we use that to our advantage in order to get what we want in terms of negotiation with the West? And I think that's how they're looking at it.
Yeah. So there's a sort of uneasy truce, as it were, in the financial war, the cold financial war. looking at the situation over gold, China now is unable to get any gold at current prices or meaningful amounts of gold at current prices out of the West because the price has been suppressed. We know that huge, great shortage. There is considerably more demand than supply at these prices. That seems to be the problem. Do you think this changes China's perception of gold at all? I mean, the reason I ask this is that going on, if you like, backing up what you were saying, I think that this uneasy truce, it's not been in China's interest to rock the boat. They have been very, very quiet and gentle, and they've just been in the background, doing what they do, making sure they don't disrupt markets. But now they can't get any more supply out of the West. The West is exhausted of its gold. Do you think this changes the dynamics in the sense that they can no longer hedge their dollar interests, if you like, by increasing the amount of gold to match?
Well, I don't quite see it that way. I think that they are facing, just with this recent very large sell-off, there have been some shortages of physical delivery, certainly in retail products. But in terms of China's ability to continue both, they're a very large producer of gold domestically, so we don't even know how much gold they're producing in China and keeping there. As far as imports of gold, the physical import of bullion has slowed in the wake of this sell-off, but that will resolve itself. And I think that the London bullion market is still working. So I think that what you're describing is coming at some point. I think that if we were to get to the situation where Western countries legislated an embargo where it became illegal to ship any gold from the West to the East, I think that would bring on an enormous reaction from China. So I don't think those things are happening quite yet. I think we're seeing early signs that they could come, but it's not really here yet, in my opinion.
Right, okay. Now, very, very briefly, I think oil is something that you follow very, very closely. Even though we've got new sources of being oil seem to continue, and new technologies to extract oil continue to be being developed, the oil price seems to be stubbornly around about the $100 mark. How do you see the future for oil?
Well, I have two different views. First is I think that the future of oil prices is in the long term much higher. We have to look at this perception that exists that the shale oil and gas boom is going to solve everything. The United States is going to be energy independent. Everything's going to just be hunky-dory and we'll go on and be happy. That sounds good. It's not true for the following reasons. If you look at the EIA's 2009 World Energy Outlook report, there's a graph in there that gives a very honest look over the next, between now and 2030, which is only, 27 years from now. We're looking at, that's 17 years from now.
17 years.
Wow. It's even more humbling when you think about it. By 2030, we're going to see a depletion from conventional oil projects. The 86 million barrels per day that we're producing from those projects currently will go down to about, I think the number is 43 million barrels per day, leaving about a 55 to 60 million barrel per day shortfall globally. Now, it's true that all of these projects, the Eagle Ford, the Bakken oil shale, the various different projects around the United States are in fact going to lead to probably as much as 4.5 to 5 million barrels per day of additional production over the next 5 to 10 years. So we just solved 10% of the global problem. Now, it's true that we've solved a much larger percentage of the United States' problem, but if you view it as a global market, it's minuscule. What that means is I think the United States is likely to impose more protectionist kinds of measures in the future. Well, we've got to make all of this oil that we're producing in North America stay in North America and let the rest of the world have an energy crisis. There clearly has to be a world energy crisis as a result of peak cheap oil. Yes, there are other sources of oil, non-conventional sources such as tar sands, which we could continue to develop, but they all have marginal cost of production of $75 a barrel or more. So the price of oil has to stay stubbornly high unless the U.S. does something to protect its own supply so that the rest of the world pays a much higher price. If we were to do that, that of course brings on trade wars and lots of other international tensions and so forth. The other thing that nobody seems to be considering is if it really and truly happened that the U.S. could produce so much oil, I don't think you'd ever get to true U.S. energy independence, but let's say you achieved North American energy independence, where Canada, Mexico, and the United States collectively can produce enough oil to support North America. If you did that, there would be no reason for the rest of the world to price its oil in U.S. dollars. The U.S. dollar would lose its economic hegemony as the world's reserve currency. The exorbitant privilege that the United States enjoys of being able to borrow an endless supply of its own currency at extremely attractive interest rates, because other countries have to hold large U.S. dollar reserves in order to cover their oil imports. If that petrodollar system were to break down, the U.S. would lose its ability to borrow money at such attractive rates. You'd see U.S. interest rates spike much higher, and you'd go into a U.S. bond and currency crisis. So this business about how everything's going to get better because of U.S. energy independence is just not true. However, everybody seems to be convinced that it's true. One of the things I look at a lot is the backwardation of the West Texas Intermediate crude chart. So I'll look, for example, at the price of the spreads from the 6-month forward contract to the 30-month forward contract. In other words, 2 years worth of backwardation. But I tend to filter out the first 6 months because they're very volatile and there's a lot of noise in that data. If you do that and you look at the continuous chart of the 6th through 30th futures month in West Texas Intermediate crude, what you see is a very clear trend that backwardation, it goes up and down in a sawtooth, but it's growing over time. And what that reflects is a view of the marketplace that U.S. oil prices are headed much lower in future years. And I think that the market's going to be proven very, very badly wrong on that point. But that's someday. Right now, that's what the market thinks, and that's what's driving oil prices.
Yes, and I mean, in all this, you haven't mentioned the increasing demand from Asia. I mean, particularly China and those tiger economies. I mean, presumably, they're all at the moment got as far as riding motorcycles, but the number of cars, the consumption of energy, and all the rest of it is set to rise at a phenomenal rate, surely.
Oh, it absolutely is, but the question is, where's that oil going to come from? Now, if we continue to have an open, free market global economy where everybody pays about the same for oil and it can be, based on the economics, exported or imported from and to wherever it makes sense, if we were to continue to stay on that plan, that massive growth in Asia, which would take us, according to the EIA projections, out to about 105 million barrels per day by 2030, where would all that oil come from? It's not going to exist anywhere. It's going to create a massive increase in prices. Is the U.S. going to allow that to happen so that everybody, including the U.S., pays much more for their oil? Or is the U.S. going to change the rules of the game and say somehow North American produced oil stays in North America, the rest of the world has to compete for much more expensive world oil that comes from the Middle East, and that means the price of oil in Asia is $200 a barrel while it's $80 a barrel in the United States. Now, certainly that's not possible if you have free market economics and you can arbitrage between markets. I think that what the U.S. is going to suddenly be faced with is the choice of whether to continue with free market economics globally or to go to more protectionist rules that allow the U.S. to enjoy a dramatic benefit over its competitors in terms of its energy cost.
So this is, they're throwing over the lessons of history about government intervention in prices and intervention, for example, intervention in agriculture in the 30s. They ended up creating huge shortages, putting farmers out of work. So they haven't learned the lessons, and they are likely to be driven, if you like, by the political imperative, even though economically it is destructive.
Well, just imagine when you have an environment, let's say that we've gotten to $10 or $15 a gallon gasoline in the United States, with the price of oil persistently $150 a barrel or something, and people have figured out that it can only continue to go up as those conventional oil projects continue to decline in their productive output. And that's crippling the economy. All of a sudden, all the rednecks across the middle of the United States are perhaps presented with a political candidate who says, we got to start playing tough with those people in the Middle East. We got to just tell them we're making the rules. We're going to not allow anything to be exported. We're going to demand that they have to import on our terms, or else, there's military consequences for them. Right now, I don't think Americans would stoop to the moral level of allowing their government to do something like extort oil from oil-producing countries at uneconomic prices just because we have the military ability to bully them around. That could change, unfortunately, if the economics change. And you mentioned learning from history. Certainly, governments have not learned from history. What I would say we should learn from history is look back at history. Have governments ever recognized that intervening in economic markets is always a bad idea, that it's always counterproductive? No, governments have never recognized that. What they've always done is seize the opportunity to tell the people what they want to hear and, unfortunately, use military force where necessary to cause outcomes that may not be fair and equitable to the people on the other side of the ocean. And I'm afraid that that's what we're headed toward.
So it's this time it's different sort of thing. Well, that's very interesting. Erik, well, thank you very much indeed for taking part in this podcast. And perhaps we ought to do it again in, say, 6 months' time, and we see how oil prices have moved and how the currencies are doing, how strong the dollar is against the others, and whether that game is already sort of over. Well, thank you very much indeed.
Well, thanks so much. I would enjoy that. And I'll just comment, a parting comment is I wouldn't be at all surprised in 6 months when we speak again if oil prices are dramatically lower. And that seems to be at odds with what I just said. The thing is that the market doesn't understand. The market believes that this shale oil and gas boom is going to solve everything. I think if the U.S. economy were to roll over into recession, which is quite likely with what we've seen out of recent economic indicators, it could easily lead to a complacency environment where oil is selling off. And if you think about the way gold sold off to that 1525 support level, and everybody thought it couldn't possibly go lower than that. We've got kind of the same thing at about $75 to $80 a barrel on oil. Everybody knows it can't possibly go lower than that. What that means is if it does go lower than that, it potentially leads to a panic sell-off, maybe as low as $50 a barrel. Now, there's no way it could stay there, but I think a panic could take it to that kind of price, and it's because most market participants don't have a realistic view of what peak cheap oil is really going to mean to the economy over the next 10 years.
Well, we'll leave it at that. So anyway, we'll watch it with bated breath. Thanks very much indeed, Erik.
Okay, thank you, Alistair.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.